Well, we got the private sector jobs report this morning, and as the thumbnail says, it's a mess. Private sector job creation slowed, says, according to a CNBC article, to a near standstill in May, hitting its lowest level in more than 2 years, as signs emerged of a weakening labor market. Payrolls processing firm ADP reported on Wednesday. Payrolls increased just 37,000 for the month, and that's below the downwardly revised 60,000 jobs in April and the Dow Jones forecast for 110,000. So the economists, the experts, thought that we would get 110,000 private payrolls created, and we got just 37. You guys do the math. That's a pretty big miss. So this was the lowest monthly job total from the ADP count since March of 2023. So going back more than 2 years. After a strong start to the year, hiring is losing momentum, according to Neela Richardson, chief economist for ADP. Following the release, Trump came out again and started, hitting on Jerome Powell to lower interest rates. By the way, if you guys were paying attention today, the 10-year yield dropped about 10 basis points, and the dollar is weaker. Gold is higher. Again, what does this tell you? There was something I saw, a Zero Hedge, a few minutes ago, that the indicators are that there will be a rate cut coming from the Fed. I don't know what the odds of that are, but I'd be very surprised to see that happening at the next meeting. It says losses in manufacturing. Goods producing industries lost a net 2,000 positions for the month, with natural resources and mining off 5,000 and manufacturing down 3,000, offset by a gain of 6,000, it says, in construction. On the services side, no surprise, leisure and hospitality, 38,000 to the positive. So again, we are a nation living, creating jobs based upon waiters, waitresses, people working in the hotel industry. And financial activities, 20,000, it says, provided some signs of strength. However, declines of 17,000 in professional and business services, that's what I do, 13,000 in education and health services, and 4,000 in transportation and utilities weighed on the total. Companies employing fewer than 50 workers, it says, saw a loss of 13,000. That was the largest. So mom and pop businesses are having a real problem, okay? Wages, says annual pay grew at 4.5% for those remaining in their positions and 7% for job changers. It says the market remains distressingly gridlocked with limited hiring and low quits, and the market can't keep steadily cooling off forever before it just turns cold, according to Allison Shivaraza, I butchered that name, said after Tuesday's job openings report. So there is your private payrolls. We will, of course, wait and see what happens with Friday's payrolls. I think that's non-farm payrolls come out Friday. Market sold off a bit today. I think Dow gave a little bit back. So let's see how this plays out. I want to share another story with you, kind of on the heels of my last couple of videos regarding the housing market. Yesterday I talked about people, pulling equity out of their houses, taking on second mortgage positions to pull equity out to pay for necessities. So this article is out of Zero Hedge today. Talks about zombie homes. Again, I'll share the article with you, but this was a massive issue in the great financial crisis when the housing market collapsed. Okay, so it says the number of zombie homes, vacant properties abandoned by owners during the foreclosure process rose in 30 U.S. states and the District of Columbia. In the second quarter of this year from the previous quarter, according to real estate data analytics company Atom, ATTOM, said in a May 29 statement, zombie homes, which can fall into disrepair and negatively impact the value of other properties around it in the neighborhood, are a sign of distress in the housing market and the broader economy. It says this was followed by Iowa and Texas, both seeing an over 50% jump in zombie properties. South Carolina and Kansas were the next on the list. According to Atom's analysis, Peoria County in Illinois ranked at the top of the list of the U.S. counties with the highest zombie foreclosure rates. Broome County in New York came in second, followed by Cuyahoga County in Ohio, Baltimore City County in Maryland, and Indiana's Marion County. Says, meanwhile, the number of property foreclosures had risen 11% in the first quarter of this year from the previous quarter. Guys, we're seeing distress, okay? Says, breaking away from the trend of 3 consecutive quarterly declines. While levels remain below historical averages, the quarterly growth suggests that some homeowners may be starting to feel the pressure of ongoing economic challenges. And again, to build on yesterday's show, those that are taking second mortgage positions for HELOCs, home equity lines of credit, are going to put themselves in a more compromised position if they are unable to make that payment, if they need to sell the property and the values are coming down. What happens? They potentially can't get out from under the house and pay off the debt unless they're prepared to write a check to the bank. And so what do? They abandon the property. Hence, you get an uptick in zombie properties. Again, just my personal opinion, I would not be surprised if we see a whole lot more of these zombie properties popping up around the country. It says these consequences can result in a major hit to your credit. The owner continues to owe property taxes that can end up becoming a tax lien. So people simply walk away from the home before foreclosure. Taxes continue to accrue. By that point in time, it's probably a foregone conclusion. These people that leave the home, abandon the property, abandon the benefit of basically living for, let's say, rent-free if they're not paying the mortgage, those that walk away from the property are unlikely to be coming back. Okay, so whether taxes accrue, whether it's a hit on their credit, that ship has already sailed for these people, okay? They're going to be in a world of hate for many, many years. Abandoned homes can fall into disrepair and affect surrounding communities. Leave your comments below. Remember in 2008, 2009, did you guys live in a neighborhood, either an association, community, or just houses around you that were abandoned and fell into disrepair? What did that do to not only the visual blight in your neighborhood, the surrounding area, maybe the enjoyment of your neighborhood, but it also had a pretty negative impact on your property values, did it not? Love to hear your thoughts and comments. So zombie properties are making a return, as is a huge uptick in HELOCs, second mortgages. The job market is getting weaker. The Fed continues to stand pat on hold with interest rates. And where is this all going to settle out? The markets are still, I think, shrugging off the risk. Not an expert here, but we'll have to see where this goes. Hope you guys got something out of these topics today. I appreciate you leaving your comments, giving me feedback, and liking the videos, sharing the videos. If you're not subscribed, I would really appreciate you guys hit the subscribe button. It's a free and easy way for you to support the channel, and we are growing. So thanks again for that. All of you you guys have a great rest of your day today. I'll be back to talk to you soon. All right, bye.